Corporate profits as a percentage of GDP are near all-time highs. I'm sure you've heard quite a bit about this. But did you know that this is a relatively recent phenomenon? As recently as 2001, corporate profits as a percentage of GDP were at historic lows. And if you look at a graph of corporate profits as a percentage of GDP, you'll notice that there's no long-term trend upwards or downwards. Despite the fact that people want to pin this all on Ronald Reagan or say this is part of trickle-down economics, corporate profits as a percentage of GDP were actually very high in 1980 before Reagan came into office. They then tanked in his first few years, and it wasn't until the mid-2000s that they returned to their 1980s level. So corporate profits as a percentage of GDP tend to go up and down every 7 years. But what's the explanation for this? Well, it turns out that one of the best predictors of corporate profits as a percentage of GDP is the United States Dollar Index. The United States Dollar Index is a chart that measures how strong the dollar is trading in relation to other countries' currencies. And it just so happens that right now the US Dollar Index is near historic lows. Check this out. When was the US dollar at its strongest? 1971, 1985, and 2001. And when were corporate profits at their weakest? 1971, 1985, and 2001. So obviously the dollar has lost a lot of value since 2001. But why does this benefit big corporations? Well, I'm sure you are all aware that the cost of living is a lot higher in other countries than it is in the US. This is due to the weakness of the US dollar. But the reason why this benefits corporations is that they can go over to Europe and then charge Europeans 50% more money for the exact same product as they would for Americans. A corporation might make $5 billion in profit here in the US, 5 billion euros in profits in Europe, maybe $1 billion Canadian dollars and $1 billion Australian dollars. And then what will happen is someone will whip out a calculator and say, okay, let's convert this into US dollars. The more valuable those countries' currencies are, the more profit that company makes. When the dollar's strong, the math just changes and the values all go down. Let me show you an interesting thought experiment. The World Bank has GDP data for dozens of countries going back to 1960. And what makes their data so valuable is that they have it available in nominal terms. So for example, we can see how the strength or weakness of the US dollar makes some countries' GDP go up, 50% in the span of 5 years when measured in US dollars, something that makes absolutely no sense in real terms. And what I was able to do is I was able to download this Excel file and I made a graph in Microsoft Excel. And what this graph is it's the GDP per capita of the European Union as a percentage of the GDP per capita of the United States in straight up nominal terms. So the strength of the dollar obviously plays a big role in that. And you can see that it, once again mimics the dollar index. Europeans gained a lot of ground against Americans from 71 to 80, lost a bunch from 80 to 85 as the dollar index shot up, increased from 85 to 95, decreased from 95 to 2000, and then of course this last decade, Europeans have been kind of off the wall in terms of their GDP because the euro went from 84 cents all the way up to $1.59 from 2001 to 2008. Then I took the GDP per capita of European countries as a percentage of the US, and then I compared it to corporate profits. And what we notice is that corporate profits, while going up and down constantly in relation to U.S. GDP, are almost the same when measured as a percentage of European GDP. So corporations are getting rich not by paying Americans very little, which is what the politicians want you to believe, but by charging their customers a lot, particularly in other countries. So in an ironic sense, even though we often associate corporations with free market capitalism, and we associate Europeans with socialism, they're actually getting rich for the exact same reasoning, which is the weakening of the US dollar. There are some other things that happened this last decade, like the huge spike in oil prices and the surge in healthcare costs and, the profiteering off the Iraq War and whatnot, which are unique to the U.S. and may not have anything to do with the weakness of the U.S. dollar. But the U.S. dollar is by far the biggest indicator of corporate profits.